Apple, AAPL, is currently rated a strong buy and the technical opinion rating for is a 100% buy with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. Rather than just buying the stock, investors can use the options market to find smart ways to trade Apple stock with an attractive risk-to-reward ratio. Implied volatility is high at around 27%. The 12-month low for implied volatility is 19% and the 12-month high is 49%. The 4th percentile is 47%. That means it could be a great time to be a seller of options on AAPL. That coupled with the potential bullish action makes it a great candidate for a bull put spread. Option trade idea 1, sell a bull put spread. A bull put spread is a defined risk option strategy that profits if the stock closes above the short strike at expiry. To execute a bull put spread, an investor would sell an out-of-the-money put and then but a further out-of-the-money put. Let's use the first line item as an example. This bull put spread trade involves selling the January expiry 155 strike put and buying the 150 strike put. Selling this spread results in a credit of around $1.40 or $140 per contract. That is also the maximum possible gain on the trade. The maximum potential loss can be calculated by taking the spread width, less the premium received and multiplying by 100. That give us 5 to 1.40 x 100 equals $360. If we take the maximum gain divided by the maximum loss, we see the trade has a return potential of 38.89%. The probability of the trade being successful is 67.2%, although this is just an estimate. The spread will achieve the maximum profit if AAPL closes above 155 on January 21, in which case the entire spread would expire worthless, allowing the premium seller to keep the $140 option premium. The maximum loss will occur if AAPL closes below 150 on January 21, which would see the premium seller lose $360 on the trade. The break-even point for the bull put spread is 153.60, which is calculated as 155 less the $1.40 option premium per contract. Option trade idea 2, sell a naked put. Naked options are hugely risky and should only be considered by very experienced traders. The potential losses are unlimited, up to the point of the stock reaching $0. That's unlikely to happen in the case of AAPL, but naked puts could still suffer significant losses if the stock has a large drop in price. Naked puts should be traded with extreme caution, and only by large traders. Once again, let's take the first line item as our example. A naked put is a mildly bullish strategy. It will make money if the stock rallies, stays flat or doesn't drop by too much. The first example is selling the 150 strike put option expiring in January. Doing this, the trader would receive a credit of around $2.68 or $268 per contract. That's theirs to keep no matter what happens to the stock over the course of the trade. However, the investor does have an obligation to buy 100 shares of the stock at $150, if the stock drops well below that level. With a naked put, the idea would be to try and avoid assignment, by closing early or adjusting. If AAPL stays above 150 and the put expires worthless, the trader makes a 1.8% gain in just over 1 month. That works out to be around 12.5% on an annualized basis. The break-even price for this naked put is calculated by taking the strike price minus the option price. In this case that would be 150 to 2.68 equals 147.32. The maximum loss would occur if AAPL went to zero on January 21, which would see the trade lose $14,732. Mitigating risk. With any option trade, it's important to have a plan in place on how you will manage the trade if it moves against you. For a bull put spread, setting a stop loss of 1.5 times the premium received is a good idea. In the case of the AAPL example above, that would be a loss of around $210. For the naked put, a stop loss of 1.5 times the premium received would also be prudent. In the example above, that would involve closing the trade if the loss was around $400. Please remember that options are risky, and investors can lose 100% of their investment.